Welcome to Wizards Institute, the #1 community to learn smart investing and financial independence.
What do Shopify, Rover, Hopper, DuckDuckGo, and Wattpad, some 40-plus disruptive companies, all have in common? One man, investment wizard Mr. John Ruffolo. John is the founder of OMERS Ventures. Over the course of his leadership, OMERS Ventures has invested over $500 million of capital in disruptive technology companies across North America. John also formed Platform Investments, OMERS' innovation arm, and co-founded the Council of Canadian Innovators, a nonprofit organization dedicated to helping high-growth Canadian technology firms scale up globally. Over the course of our conversation, we asked John to share his vision for the Canadian tech scene, his investment philosophy, and how he sees the pandemic impacting our society and future investment opportunities.
So again, my name is San Ing. I'm dialing in today from Toronto, and I started this platform called Wizards Institute. Initially, it was called FIRE Institute, called FIRE standing for Financial Independence Retire Early. Initially, it was really just to work with my 3 teenage daughters to, after we read the Rich Dad Poor Dad book, John, to really learn about ways to be financially independent, multiple incomes as a learning experience. And then as we did this, we felt that, listen, we should broaden this to really learn about smart investing. And, in the short span of a few months, we've evolved to say, let's make this a book project. So we've now found a publisher, a quite established book publisher out of the States called Morgan James. And we're doing this as part of a research for a book called The Investor's Bible. The 10 commandments of the investment gods. Of course, we're now facing one of the investment gods. The idea is that there are obviously many, many great investors, household names like Dalio, Buffett, and a lot of investors are well published, but there are many investors, for example, we did a few from China that are not in the English press. So the idea is that we've now probably at 60 primary research, including some interviews. And the idea is we're trying to find what are the themes, or what we call commandments or guiding principles that make all these investors superstars, such as John. And we're having these evolving. And so this is work in progress. We had a wonderful session last week with Kathy Xu, who's Forbes Global Midas List number 17 from Capital Today in China. And I'm sure we'll learn just as much, if not more, today from John. So that's the idea. This is a research project. Again, I am extremely humbled and honored to have John here. John's name, if you Google him, his name is usually right next to Justin Trudeau or Drake as the top 30, top 50 most influential Canadians in North America. So John, I really appreciate it. I know you don't do a lot of this, and I do know that you're very generous with first meetings. This is our 3rd meeting. And I know that you said the 2nd and 3rd meetings must be earned. So again, I'm humbled that you're giving me a 3rd chance to talk to you, John. So really, that's the background, and the output would be we'll record this session, we'll put this on YouTube. A number of folks couldn't make it, wanted to see. We'll also edit this to a podcast, so people can really listen to yours as well as an article, and hopefully we'll learn some great stuff to include into the book, John. Okay, and so the format is simple. We want you to talk, not me to talk, John. Again, your reputation is just amazing. I mean, if we look at the list of these crazily, insanely, the most profitable, the most valuable company in Canada, Shopify, but other names, Hootsuite, Wattpad, Purpose, plus not only direct investments, you've also created and invested in a number of platform companies such as Purpose, Ether Capital. So you're really in this perch of really can tell us how you, now we want to learn how you invest, John, right? What is it thinking? What are the commandments or guiding principles that you have? Really want to focus on that. But maybe we will start with a bit more about your background, how you got to OMERS, how you got to where you are today, and what you're up to today as well. John.
Sure. Well, thank you very much. And thanks for everyone for coming in at I know it's a tough hour, and a lot of you spend your family time right now, so I do appreciate that. So my background is a financial background, really going way back, is actually an accounting and taxation background.
Mm-hmm.
But very, very early on in my career, I started the first industry practice for the firm at the time was Arthur Andersen, which was the other half of Accenture. And I started the technology practice servicing technology companies. And that was really the starting point of me seeking to understand how these companies operated. And frankly, I've just been doing this for now, focused in on this industry segment for about 30 years. And, one of the benefits that I do have is not only did I make thousands of mistakes myself, I had a great opportunity earlier in my career to watch a multitude of folks make hundreds of mistakes, but also learned what was working so well for them, and was able to learn some of the best practices that they were using from an investing perspective. And I had the benefit to test a lot of those theses, when I built OMERS Ventures. So left Deloitte when I was at the time I would have been the global thought leader, the global technology leader. Left to join and build OMERS Ventures, and then to build what was called OMERS Platform Investments, which really was the opportunity to look at a variety of different investment theses, really predicated on where the world was going. And it was an interesting platform to kind of put your money where your mouth is, really based on future trends.
Okay. And how long were you at OMERS, John?
8 years.
How many? 8 years.
Yeah.
I see. And you left recently, right? And in the
Yes.
last year or two.
Yes.
Okay. And I see you're still very active in a number of boards, both profit and nonprofit.
Yes, and I'm currently working on a project that was really the result of a lot of testing of a thesis that I really started around 2016. And it took me about 3 years to really nail the thesis, and working on that project right now.
I see. Let me just make sure everybody's, I'm going to just mute everybody again. And then I need to unmute you, John. Okay, John, you still, yeah.
Yep.
Okay, can you talk us through the OMERS strategy? You were CEO for 8 years. If you did 20, 30 deals, you have one hit, that could be an accident. But for the number of deals that you have, it's not an accident. Can you talk us through what was the thinking? Was there a theme? I'm sure there was. Just
Sure.
How did you formulate that process?
Yes, and I would say, the truth of the matter is, when you're investing, I'm gonna use venture investing right now, although I did a lot of investing beyond that, but let's just use venture investing.
Sure.
The truth of the matter is, you really need two things to work together to have real success in it. Number one is, quality deal flow, for sure. But number two, it's quality deal flow at an attractive entry price. So, when you look and think back, and one of the things that I do is that I actually always start from a macroeconomic perspective and think, where do I believe the world is moving to first? And then I worry about the micro. So let's just talk about venture investing in technology companies very, very narrowly in that segment. Because I'm an old man in the world, the one thing that you do see is all of the cycles, and timing is always important, even on something so long-term investing as venture investing. And so when you look back and you say, what really gave rise to the last 10 years of venture capital investing in technology, the magical year, in my view, that really started it was 2008. And in 2008, three massive technologies all crossed the chasm at the same time. They all started at different times, but this was cloud computing, mobility first, and social. And what happened in 2008, coincidentally in the last Great Recession, those three forces came together, and it actually delivered the promise of the dot-com boom 10 years prior. And it was really that point that a lot of the technologies that we see today, although they were imagined beforehand, they actually could not have been executed. And if you accept that 2008, and I can go through the history of what exactly happened specifically, but if you accept that just for the moment, and then you layer on an entrepreneurial lag effect, typically about 3 years. So this is the lag of, now that everything's crossed the chasm, you started to see a lot of technology companies in the depths of a recession starting to make sense of these technologies and started to imagine, really from a creative destruction perspective, what was imaginable but not executable, and now they were executing. And when you add 3 years, basically 2011 was the first vintage year of venture capital investing where you could really make some serious dollars. So by a complete fluke, that's when I started OMERS Ventures. And that's the timing part. And the only thing, and that timing was fantastic up until about the end of 2014. For those 4 years, and as an investor, I mean, for those 4 years, quality deal flow continued to rise, and almost on a weekly basis, unbelievable new stuff continued showing up, but again, at an attractive price point. What started to happen is by the end of 2014, massive impetus or influx of capital came in, both in the US and in Canada. It was facilitated by virtue of the Venture Capital Action Plan, which brought in a lot of capital at the end of 2014, beginning of 2015. And so in those 4 years of 2011 to 2014, the reason why we had so many of the top companies, frankly, was a combination of less competition for deals at the time. So it was good for an investor, not so good for the entrepreneur, perhaps. But the big thing that we brought here, and it was largely because I was an advisor to so many Silicon Valley-based VC firms, and again, going back to my earlier comment, what worked and what didn't. When someone has a high conviction of an investment, and what I learned from the Valley is, if they wanted to put 20 or $30 million into a deal, they would do that, but they wouldn't say, you know what, we love this company, it's unbelievable, let's just put $3 million or $5 million into it. And that was number one. So they really bet when they had high conviction. The number two thing that I learned, and this is the hardest thing that I had to learn, was at the very beginning, our failure rate was too low. And by that, we weren't taking enough risk in the venture investing world. So, and this was the cultural issue that I had to get OMERS over of when I said we really need to take greater risk by having more failure in order to generate greater returns. And that's kind of counter to what you will see in buyout, private equity, or infrastructure or real estate. So it is a different game, and what it enables you to do is when the Shopify, as an example, came about, Shopify still in the last 10 years is the clearest example that I have ever seen where, frankly, if you saw what we had seen, you'd want to make the bet. And it was not only the biggest bet we made, we actually breached our concentration limits and got OMERS to buy in on that because we just thought this is the horse to bet on. So sometimes pushing that, I don't recommend that for in all cases, but the whole team had a high conviction. It wasn't just me. And so again, when that happens, you really got to open it up and parlay it like you've got a great poker hand in some respects. And what I find sometimes, this is less so of a case, the Canadian investing was notorious before 2010 of not taking risks and playing it very, very safe, but it actually hurts you when you do that on venture. Gotcha.
That's great. By the way, for the audience that's coming on for the first time, we typically have a soft stop at 9. We'll stop typically 15 minutes before that. You're welcome to please text your questions for John anytime, and towards the end we'll direct those questions to John. And with John's consent, hopefully, and audience interest, we could hopefully stay a bit longer than 9 o'clock. So John, so you met by fluke, but your timing in starting and running OMERS, it sounds very fortunate because you're the nadir, right? Post 2008 and the past few years after that. So valuations received a lot of deal flow. So your timing was great. Now you talked about this bells ringing in Shopify. Can you talk us through what was so different about Shopify that gave you such massive conviction to even violate your concentration rule? It's unusual. That's very unusual, right?
Yeah, I mean,
funds don't do that.
When you where Shopify was similar to other companies is that, again, in venture investing, because you don't have a long track record of earnings, et cetera, the role of the team that you're investing in, plays a very, very large disproportionate role. And, Shopify had outstanding folks, as do a number of other companies that we've invested in. But where Shopify was particularly unique, and it was certainly the most interesting that I've seen, you could clearly see the power of scale. Now, two things. Number one, they were in a market that when you imagined the size of the market, we were, looking at the market, not even in the billions, but, it's the size of commerce. We were thinking they're in $1 trillion plus market. So they were in a massive market. But the thing that they did that was fascinating, at least for me, was when we looked at the e-commerce space, we really stayed away from all e-commerce plays and focused in on the underlying infrastructure because we were not equipped to bet which brand is going to win or lose. But you could specifically identify in Shopify, if you put $100 at the top of the funnel, you could actually see how that $100 turns into $20 pre-tax profits. And it was very identifiable, and they were very clear and precise on if they raised not $100, but $10 million, you could actually see how that $10 million would actually translate very clearly into the scale of their business, because they really nailed scale better than anyone I've seen. So when we started talking, we turned the discussion to, well, Jesus, if you can do that, why not raise $100 million and really blow this out of the water? And at the time, there was two similar sized competitors. One was called Volition, and the other one was called, oh my God, sorry, the M. It was backed by Revolution. I can't remember what it's called now. Oh, Big Commerce. Sorry, Big Commerce and Volusion. These are two names that I'm not sure anybody remembers those names, but in 2013, they were of similar size. I think Big Commerce was even bigger than Shopify. And we basically thought that if they raised this, at the time, was an unprecedented amount of money for Canada, that we would, in essence, declare Shopify the winner and suck the oxygen out of its competition. That was at least the thinking. And not only did Shopify do that very, very quickly, they just executed with such precision. It's just it was a thing to behold, to watch them. And I would say, while every investor loves to say their value add, and they all got these great things to add value to their portfolio, the real truth of the matter is, if you pick right, there's an inverse relationship to adding value and success in many cases. Because in the Shopify's case, I admit, we were helpful whenever they asked, but to be honest, they were so damn good at execution, they really didn't need anybody's help.
Yep, I think that was my experience also running my portfolio out of China. It's, you always market as value add, but you're right, the superstars don't need your help as much.
Right. Thank God. We may have hurt them if we added too much value in that case.
Yeah, you still market it anyways, but really that's not the case. I totally agree with that, John. Now, so we talked about macro, talked about Shopify. At the time when you started, or even now, did OMERS, do you and your team have certain themes? You see a certain feature, a certain sector.
Yes.
And could you walk us through that? Like, was this mapped out, and you actively actually looking for, you've got these boxes of certain sectors, right? Certain spaces. And could you?
Yeah. So, we had 5 themes, and, you don't pick them randomly, and the themes, I'd say, not all the time they become a theme that hits it, but when you're attracting deal flow, there's really 2 ways to attract deal flow. You either go out and find it, or it comes to you from reputation. And the truth of the matter is, I would say it's about 50-50 in terms of where the deal flow comes. And when you have certain predetermined themes, so I just gave you one, for example, on the e-commerce side, the theme really was stay away from investing in brands and looking at the underlying pipes, so that you make money no matter which brand is using your technology. But what it does do is, first of all, it allows you to be highly sensitive when an opportunity does come that matches to your thesis, or doesn't match to your thesis, and you continue to update your thesis. It is a way to attract more deal flow, and ideally higher quality deal flow. when opportunities come your way, not in your thesis, I would say, generally speaking, the investment rate or our hit rate on those deals were very, very low, because a lot of them really weren't just things that we had high conviction on, or things that we just didn't really know the space very well and didn't think that we could add a lot of conviction. Like, give me an example, where are semiconductors going? Well, you know what? We really didn't know that world very well, and honestly said, you know what? There's better investors than us, because we really haven't spent a lot of time on that, and we don't have the people that can really provide you value. But even today, there's about 5 investment themes that I have right now that, again, really started off developing as early as about 2015, and you just continually refine it and update it. And right now I'm just updating my theme just based on COVID and seeing what, if any, impacts COVID might have on any of these particular investment themes.
All right, you're leading us to probably one of the most important questions. Can you talk us through your future 5 themes, or just the first few themes that what does it look like for you?
Well, let me start off, and I know folks are going to go, okay, did you seriously say this? I never predict timing right, ever. But starting in 2015, and largely due to one of my advisors, his name is Peter Zeihan. He's written this book. The guy's an unbelievable geopoliticist. And again, I spent a lot of my time at OMERS really looking at the global macro picture. He wrote this book called The Accidental Superpower, and since has written 2 other books, but he's been a very, very helpful advisor to me to really understand, starting at the macro and then getting to the micro. But starting in 2015, I was predicting a massive global recession in the second half of 2020. Now, I believe COVID hasn't triggered anything per se. I shouldn't say COVID is not the reason why we're in a massive global recession. It was the triggering of the lack of confidence. Now, in about 2017, 2018, I can't remember, I re-refined the second half of 2020 being post-US election. I thought that Trump would likely win based on what he had done in the economy, but then he was going to throw every single stimulus that he could possibly have at his disposal to win the election, and then post-election he wouldn't have cared and it would have all gone wayside. And I thought that was going to trigger this massive global recession. But really the reason why it's happening, it's really a result of the US retreating from the world and going back and reverting back to its pre-World War II policy of isolationism. And when you look to understand how the US protected global trade, and it made a lot of countries very, very wealthy by protecting their trade for free. And under Trump, it was clear that while every president started a trend to start to isolate, Trump just ripped the Band-Aid off. And so you knew this was going to happen. And also for demographic reasons, by the year 2020 is the absolute peak of 65 years ago was the peak baby boomer period in 1955. And the vast majority of baby boomers will have retired in 2020, which was going to see a corresponding decrease in consumer-led demand, and in particular energy usage. This was all predicted. And in that same time in 2015, one of the things that I had done at OMERS was basically get out of all private investments in energy, because I thought that this was going to really happen in around 2020. Now, I did not predict it was going to be a virus that triggered it, but that underlying expectation of a massive global recession, I thought it was going to trigger the next wave of investing, and I was going to look at 5 industries in particular that I had deep knowledge or semi-deep knowledge in: the future of financial services, future of healthcare, the future of what we call live, work, play, and learn. It's a code for smart cities. The future of retail and the future of transportation and logistics. And those 5 areas, which are relatively large, but those 5 areas I thought would be the most impacted by the breakdown, basically, of global supply chains. And we're going to revert back to what trade was like, frankly, pre-World War I, frankly, when you kind of even think about it. So that was something that I was gearing up for. And going back to the venture opportunities, one of the big things that I was saying is, when you look at the venture world, 2008 being the marquee introduction of, or the crossing the chasm, not introduction, of those 3 massive technologies. The truth of the matter is, there really hasn't been any dramatic, impactful technologies that have been introduced since then. There's a few that, if they were to take hold, like, it will change the game again. 2 in particular, quantum and blockchain. If those 2, as 2 examples, truly take hold, I think you'll see another wave of creative disruption. But when people talk about AI, for example, it's been around for 30 years. It just hasn't been enabled because we didn't have the requisite data sets in order to apply a lot of the AI technologies, number one. And number 2, we didn't have the computing power. Now that we do, I don't throw AI as a new technology, but rather a more efficient way of doing things, as opposed to human labor, as an example.
Okay. John, this is fascinating content, a lot to unpack. I want to just come back. You talked about your predictions really for 2020, which I think, I think you're alluding to, the COVID just accelerated.
Yes.
Your prediction, right?
Yes,
or sort of
correct. It's
cemented that.
Correct.
And if your prediction originally was not COVID driven, it was really supply chain driven, really, and that itself is caused by Trump's or sort of the anti-globalism, right?
Yeah.
The geopolitics, then these predictions should stay true. In fact, it's just accelerated, right? In terms of these 5 themes, right? Is that, so I just want to make sure I got that part right.
It actually, sorry, and I was sorry to interrupt. COVID, in my view, has just accelerated the underlying trends that were already all pre-existing, number 1. But number 2, what it did, which I didn't expect, it also exposed vulnerabilities that I didn't pay close enough attention to. So when I mentioned about broken supply chain, I didn't correlate broken supply chain to safety of food supply or safety of, health equipment. And COVID allowed me to narrow those 2 in particular, because we just saw how exposed they were. It's a pre-existing problem, but it just helped me clearly see what the impact of something like COVID would do if we don't really pay attention to that.
Yeah, that makes sense. I want to maybe go one step higher level and then drill down to the technologies that you mentioned. So Mr. Ray Dalio, I think many of us are fans of him. He's been dishing out a lot of great content. So his thing is, we have not seen, the world has not seen since the 30s this trifecta of massive drivers. One is obviously this quantitative easing, global debt, which is it's just, the numbers are just staggering. Second is U.S., but certainly Canada and other places, is a growing, accelerating wealth gap, right? Hence, the revolts and riots are there's a reason for that. And third, which is tying to what you said, is this whole geopolitics thing, right? And he said basically, whenever there is a emerging power, China, challenging a declining power, U.S., right? there's shit to be paid. Right? Bad things happen in history, right? And so this kind of ties into your prediction also about the whole anti-globalism. So maybe talk to us a bit more about that. If you agree with these three major forces that we have not seen coming together, is converging together since the 1930s, are we in as bad of a shape as Mr. Dalio says we are? And if so, how so?
Yeah. So, I mean, I don't know, but I would say to you, what COVID, COVID has added one new element. So, the quantitative easing, the cheap money supply, the abundance of capital, and the cheap supply of capital, has really mispriced risk in many ways, and all assets have been overpriced. I mean, we're still seeing the stock markets basically at highs again. Like, it's because of the abundance of capital, and
yes,
the demand equation is the one that concerns me. Now, I do think that post-COVID, the demand curve is going to go, I say back, but it won't go back to where people are expecting it to go back to, because it was already on a line downwards if the population demographic issues continue going where they're going. Let's even look at China. China is, when you map out and look at their population pyramid, you're seeing a massive collision course for China, in that they're going to be they're starting to see the effects of the one-child rule, which, even though it's now increased to 2, the problem is you can't replace an entire generation of people that don't exist. So again, if you were to read the Peter Zeihan as an example, and there's a number of them like it, this decreasing demand, and particularly on the energy side, it looked like it was going to happen as well, which really presupposed that we were going to go into this no growth or low growth period in any event. And the concern that I have, and frankly, I'm one of the people that helped create this divide, or this, polarization of income, with more and more technology adoption. Technology replaces human labor. Let's use AI as the example. And this has happened over the last 150 years, so you could accuse of being a Luddite. But the problem that we have never experienced is the replacement of humans by technology has been growing at an ever increasing speed, and it's been growing logarithmically. And what COVID did, it accelerated that adoption even faster. And the problem is, it doesn't give enough time for the human labor largely to readapt and to get redeployed. So you end up with a potentially lost generation of workers who cannot replace the levels of income that they had when they were handling the machinery. And what I do worry about is the resultant social issues that you get as a result of that, and the issues around universal basic income start to come to play. And again, what do you think CERB is in Canada? It's universal basic income. So it's fascinating. These very issues that I've been grappling with since around 2015, like, all happened in a matter of weeks. And so I'm not surprised on anything per se. I'm just astonished at how fast it went, but I'm not surprised at the result. And I am a little worried, does society have enough time to react?
Okay. John, can you share a bit more about, it sounds like you've put quite a bit of thought to it over the years, this whole geopolitical thing. The issue with China is not going to go away. China is getting stronger. US is not going away either. So So you're going to always have that friction. I think that's going to continue whether Trump wins or Biden wins. It's going to continue for a foreseeable future. So how does that translate into, obviously, then logically stuff is made in China, so you got to have a diversification away from China. But how does that translate into an investment thesis? Can you kind of talk us through a bit more about that?
Yeah. So let me give you one example. One that this was one investment thesis that actually COVID really highlighted for me and accentuated the vulnerabilities. So, in one of the themes of the healthcare and wellness, I spent a lot of time at this at OMERS, was really the future of food, and spent a lot of time on the drive of protein and protein replacements and all that sort of thing. And what was interesting to see was the rise of protein consumption actually didn't correlate with population growth. It actually correlated with wealth creation, which was kind of interesting. And looked at a full thesis, right from farmland right to basically the table, and came up with a theme that we're going to focus in on the last mile of food supply, and as opposed to making direct investments in that space. This was the impetus why I made an investment in Arlene Dickinson's District Ventures to hit that one thesis, and just to kind of test out that thesis. Well, we spent like 2 years on every element of the supply chain of food, and yet went through the manufacturing or processing, etc., but never ever nailed what happens if the supply chain, the physical supply chain, is threatened. What do we really do? And thank God we have a good relationship with the United States, or we'd be catastrophic in Canada. Now, one of the themes that I was starting to develop was really infrastructure relating to food. And I think what we're going to see is, you started to see more on the hobbyist or small scale front on indoor ag. Well, I think this is going to become a new infrastructure asset. And I started to see this a little bit in 2017, 2018, mostly in the Middle East. But when you look around the earth and you add in the environmental impacts of climate change, there's going to be fewer and fewer places in the world that can do outdoor farming effectively. And because of technology, we're going to get to a point, and I don't think we're there yet fully, but we're getting really close, where the cost of indoor farming will have parity with the outdoor farming. And it's really because of efficiencies with LED lighting, irrigation systems, etc. And when you think about it, it's going to offset the cost of being free rainwater and free sunlight. Now, if carbon taxes really start to come into play, it might even be a smaller differential. But now all of a sudden, when I start to think about that, and I was thinking about that thesis in a different way. I wasn't thinking about it in the protection of our food supply chain. I was thinking about it, really with a climate change lens on it. So there is one right there where I say, you know what? We may have these massive football field types of indoor farming, and remember, they'll be within 100 miles of the major city that's going to be consuming them. So the logistics and transportation cost will be negligible for those goods. But if I am right that the supply chain costs are going to go through the roof because all of a sudden shipping is going to be way, way more dangerous with the US not protecting global shipping lanes, etc., the cost of trade is going to go skyrocketing. If that happens, this idea that I just said goes right through the roof. So there's just an example of correlating what would otherwise be two different themes that you'd think are not correlated, but in fact, they might be very well correlated.
Yeah, okay. No, that makes sense. So population growth, geopolitics making it harder to trade, and then you really need to focus on food. You mentioned food tech, but really also ag as well in terms of feeding. I guess we'll be going to 10 billion people at some point in the next decade or two. And I think I had seen a study a while back from Cornell that the Earth is supposed to support up to 2 billion people, sustainably. So we're already way over that.
Yeah, I think the number that I see was 500 million. When the Earth is in complete balance, I know.
Yeah. Okay, there's a lot of questions from the audience about different sectors, but before we get there, I want to wrap up the macro and maybe just kind of push you a bit more to share from your vast experience, including failures, John, right? Investing directly in the Shopifys of the world, but also investing platforms. What are some of the, I guess, investment, not themes, but again, I call them commandments, but guiding principles or even rules that you would recommend for less experienced investors such as myself in the audience? There's certain things that kind of, if you were talking to your son or daughter and they're just getting into the business and like that, what are some of the things that I should never do or I should do? What would be yeah.
So this is easy for me because I made all the mistakes, so I just could recite some of my my biggest.
Yeah.
Again, the earlier you're investing, this is more acute, but really you're investing in people. And when I fell in love with the opportunity and the thesis without spending the requisite time with the management team or the founders, in a number of cases, it really bit me. And I really started changing my approach to getting to know the individuals first and kind of reversing that. And as well, taking my time. You can get really caught up in, having, the fear of missing out. It's notorious in venture investing. And the truth of the matter is, if you're not comfortable or you don't know a segment as well as you would like, it's okay. Just passing it, be honest, transparent, and the next one will come along with the right party. And it's a little bit of, when I've heard Warren Buffett, when he's spoken, and he always says the same thing. I just try to avoid making really stupid, foolish mistakes. And again, in venture investing, there is making foolish mistakes, and then there's making taking smart risk. Taking smart risk in venture enables you to maximize your return. And like I said, having a high failure rate. And it's just trying to avoid the really dumb risks where, you were really negligent in spending the requisite amount of time. You believed in something, you invested in something because you're hearing another firm is all over it, and then you must be missing something. The number of times that I felt like an idiot where I would pass on something and then another firm, particularly from Silicon Valley, would come in and then I'd feel like an idiot going, oh my God, what did I miss? And not perfect by any stretch, but way more of the time, it was a bad investment because I knew the people better than they did. And they kind of flew up and they knew the thesis better than I did, or they knew the space better than I did. So that's really helped me just take it easy. And particularly right now, even in this COVID period of time, while I've been investing in the public markets and taking advantage of the dips, in the private markets, I'm just, chilling because there's going to be a lot of false positives. And as well, I think that there's a lag effect on the private markets compared to the public markets.
Great. In your experience, John, I've heard of studies saying alpha generation, so profits from investing, and I think this refers more to public markets, but I would imagine it would be similar. They're saying most trades or investments is 40% is from the market, the gain is from the market, 30% from the sector, and 30% from the stock of the actual company. Do you agree with that assessment? Whether it's public or private?
Yeah, private is, I don't think private, I'm not sure you'd be able to do that on the private side. I mean,
well, I guess in a case like in Shopify, obviously you picked the right horse, but you also picked the right, your market was correct, as you said, your market was correct.
Yeah,
you came in sort of towards a nadir, and then you picked obviously the e-commerce sector, and you picked the right horse. Again, I'm not sure if that applies as much to private.
It's easier to do it in the public side because you have all of the information. You can compare multi-jurisdiction.
True.
Venture is a much more localized business, so it's much harder. And again, I'm not an expert on public markets, but the one thing I will say, and again, I never, ever, ever get the timing on the publics right, but I piled in on March 23rd. Now, if any of you know what happened on March 23rd, it was the very bottom of the cycle. Now,
nice.
But I did not go into anything remotely looking like indexes. I think, generally speaking, the indexes are not only overvalued, they're being driven largely by 5 massive stocks. So I went in on very, very specific, 5 specific names that I thought that they were so massively oversold. So that's about as good as I can get in terms of kind of answering your question. But on the private side, I do start off on the macro all the time and then drill down to the micro. But it is much, much harder to compare companies.
Yep.
You try.
Sure. Yeah, I think the purpose of that study was, I think most people, maybe men in particular, tend to fall in love with the stock, think they can pick the right stock. Whereas again, 70% of the alpha is really not the stock, but really the market of this sector. So I mean, that's a lesson that I'm learning myself. Yeah.
That point. Yeah. Sorry, I misunderstood your point. I feel completely overmatched. Human beings trading now, like everyone's on a trading program, and you just cannot compete. But I've only really made 3 massive trades on an individual stocks over the last 20 years. And you know when they were? 2001, 2009, and 2020. And I piled in hard and very narrowly and almost similar themes. And that has been driving the vast majority of my returns over 20 years. And I'm not smart enough to do anything else beyond that.
That's amazing. That is amazing, John. Wow.
I'll come back in 6 months and tell you I lost my shirt.
No, that's conviction and courage. That's conviction and courage, right? You need both of them. So we're approaching 9 o'clock. Being in Canada, there's a bunch of Canadian questions related to Canada. So I think Cecilia Jen said, "Hey John, do you feel Canadian pension managers now have developed a higher tolerance for venture risk investments and making us stronger in the space?" I think I know the answer, but I mean, this is obviously the answer is driven by John.
I would say they've grown to like the technology investing asset class, and many have felt that they've missed out, particularly on the big run from 2011 to 2014. A lot of them, they said it to me personally. But your question is, has their risk appetite changed? And I would say I'd say the answer is no. And the reason is, there's lots of pressure on these folks to deliver these pensions. And when there is, a pension fund, particularly those that are liability driven, really, it doesn't matter if they really hit out the lights. What they really want to do is make sure that they meet the obligations. So they're not looking for the highest return. They're looking for the highest risk-adjusted return. So the issue that some of them have on the technology front is you can't deploy enough dollars, and perhaps the risk meter is off the grid. What's really changing now is disruption always starts on the bottom. And, although, 10 years ago, all this disruption was happening in these very, very small companies, it's now infecting all the way up to their largest portfolio companies. So before you could try to avoid it, but now you better embrace it because it's actually impacting the entire portfolio. So that whole risk tolerance issue, I actually turn it on its head. The riskiest thing that a pension fund could do is to do nothing. And you're seeing a number of them reacting to this asset class more so than they did in 2011.
Okay. There was a number of questions on the sector because you mentioned quantum and blockchain. There's a couple of questions on blockchain. I also might throw in, and I understand that you might think it's not a new disruptive technology, but the space that I've personally gotten a lot of conviction on is the space occupied by Tesla in terms of energy and transport, which I see just killing a lot of traditional incumbents. Maybe we'll go to blockchain since there's a few questions on blockchain. What's happened? What's happening? There isn't. It's quieted down. I know there's a lot of stuff happening in the background. We had Bobby Lee come on a few weeks ago, who started the first crypto exchange in China, and there's a chairman of the Bitcoin Foundation. I'm trying to get Vitalik to come on as well at some point. So I know you've got a lot of experience, but maybe what is going on right now with blockchain, and then to a lesser extent crypto?
Yeah, I mean, I don't follow all of the various currencies, and frankly, the time that I was spending on the blockchain, I really like the underlying technology, so the actual blockchain technology itself. And the one that I was most focused in on at the time was Ethereum, and why Ethereum? It was really the power of the contracts or the executions that it could have, and I was focusing on that. I was not focusing in on the cryptocurrency aspect of blockchain technology. whether it was Bitcoin, et cetera, because that felt like to me more of just in essence currency trading, and that's just not something that I know well, nor was part of my mandate. So and Bitcoin seems to have done okay during this time period. Although I haven't looked at the latest results of it. The interesting thing, it hasn't correlated with gold, by the way. There's a lot of thesis that it should have correlated with gold, but it didn't. But I think it's done the best by far of the other cryptocurrencies. Yeah.
So again, Bobby was on here a few weeks ago, and Bobby's probably the top 3 global most bullish, consistent bullish Bitcoin guy, and he's predicting still a million pricing, and I totally respect him. Right, he and his brother have done a lot for the space. His brother's is Charlie Lee, who's created Litecoin. Yeah. So my issue with Bitcoin is, and you own some, I own some, is the whole idea of decentralized store of value, not the transactions. And really, I was hoping for a massive uptake because you've got this geopolitical thing. You got QE, right? You've got extreme volatility. You got Venezuela. I mean, what more impetus do you need
Right. I
for
agree.
essentially the thesis of Bitcoin for this to go to 100,000. And it didn't really move. It didn't go down, but it didn't really move. So that's the part that kind of baffles me on the Bitcoin side. But
Yeah, no,
yeah,
I agree. That's what I was saying. It didn't correlate with gold. That's why I don't understand the supply demand equation. It makes no sense to me. It's frankly, I've spent a lot of time with a lot of folks, and the predictability of that, and the experts far greater than I. So that's why I stay away from that. But I do love some of the, the ideas on the security and privacy side, for example, on blockchain. Like, it still is, to me, the panacea. And my point was, when you look at the third OMERS Ventures fund, you'll see in there was the first time started to invest in blockchain. And I was always worried that am I a little bit too early on that? I think probably, but that's how you make money again. But I'm still bullish on the blockchain in whatever form it might end up being.
Okay.
So
we talked about, I think it sounds like we agree on the Bitcoin and the crypto. On the blockchain side, I get the technology security. I think a lot of excitement came, when I first met you, we were talking blockchain at your office, and I got religion on it, mainly because the ability for blockchain to offer decentralized governance, right? But I'm not really seeing that. I haven't followed it, whether it's Libra or the Chinese digital yuan. They're using blockchain, but it's all centralized.
Yep.
Right.
Correct.
So then,
or private bloblockchain. Yeah.
Yeah, which is not decentralized. So
correct.
So what's why is blockchain still sexy to you if it's just a glorified but cumbersome secure spreadsheet?
Yeah, I wouldn't. I only believe in the public use of it. I agree with you. I want no one in control.
Yeah.
So I guess the question really is. This is why I just say, I think that if blockchain really does become the technology that we believed it should have been, that will launch another wave of technology innovation. But right now, I can't see it. So right now, I'm not making any investments in that space. I am a little, I still believe in it, but I'm more on the wait and see and watching how it evolves. Quantum a little bit differently. Quantum, the one investment I made was in a company called Xanadu, and I looked at all the quantums in North America relatively deeply. And by the way, I am the first to admit I don't exactly understand it. And as somebody said, if you think you understand quantum, you don't understand quantum. I will proudly tell you, I don't understand it fully, but I understand the commercial application for it. That I understand. And the only reason why I made that investment now, and again, it could be a little bit earlier, that this Toronto-based startup was doing a room temperature quantum computer, which was absolutely fascinating, because the one question I kept on asking, how do you miniaturize this damn thing and keep it cool at a price point that's below $100 million? And I didn't get any good answers from any of the other opportunities. But quantum, I think, if that does become real, and whether it's 5 years, 10 years, or never, who knows, but that will unleash an unbelievable wave of creative destruction on so many fronts.
Maybe that you can't stop there, John. Can you? I don't know anything about quantum, so can you just elaborate a bit more? It sounds
well. Just in the most basic sense, all security and privacy as we know it has to change. All of it. Every encryption methodology that we currently use, as far as I understand, completely breaks down. What a monstrous opportunity. Now,
wow.
there's a lot of calculations that we do right now that obviously don't need a quantum, and non-quantum computers can do it far more effectively. But looking at, optimization, the most complex of measuring, whether it's weather, climate change, etc., the possibilities, but also the fear of it just seem limitless. But again, you also still have the detractors. And again, I just don't know enough. I just read, is quantum really real or not? I'm on the side of the fence that says it is real, but it still has quite a long way to go.
Okay, and is this like a 5-year or a 10-year?
I'm thinking in those time frames.
Gotcha. Okay. Do you follow the transport, the energy source space, the Tesla space? The reason is we are primarily focusing on the investment themes of professional investors such as yourself, but there's a few folks like Elon Musk, Jeff Bezos, Li Ka-shing that we felt are going to be featured because they're entrepreneurs, but they also think in many ways long-term investing. So I'm just curious, we'll use Tesla as one of our as a case studies as well. I'm just curious if you follow that space and what you think of the bull case for Tesla in terms of disrupting the entire energy chain and disrupting the entire transport chain.
Well, I mean, I'm not, I follow them by, reading what they're doing. What I'm far more focused in on is really the carbon-based versus non-carbon-based energy trend. This is an area that I've spent a lot of time on. And I am long-term bullish that we will continue to see decreasing demand for carbon-based energies. This was very predictable. What was unpredictable, in my view, was the price war between Saudi Arabia and Russia to massively decrease the prices like that. That I didn't, I didn't expect. But the long-term secular decline in carbon-based energies, I think, was already happening. And what people forget is a company like Tesla, when they're coming out and they still have, very, very small market share, but for every car they manufacture, that is a permanent elimination of fuel for that vehicle. And then it obviously has this, compounding effect. I believe that we're past peak oil. And so, the real issue is two things. Number one is looking at base load power solutions. And right now, wind and solar do not replace base load power. Hydro does, and nuclear does. But the moment we get large scale batteries providing storage, I actually think we're going to start to see this needle move far, far greater. And so to me, I'm bullish on, vehicles relying on nuclear, renewable energy, whether it's Tesla or not, who the hell knows? But they certainly are pushing all of the other car companies very hard. And you remember early on, all the car companies just basically poo-pooed them. And now, now they're afraid of them.
Yes. Well, yeah, this is also timely because they were supposed to have had their battery day, which, so the Chinese partner supplier CATL already announced a 1 million mile battery. And that's significant because once it gets to 1 million miles at a certain cost, the EVs become cheaper than gas power cars. And apparently Tesla is announcing something that's going to be beyond 1 million miles.
Oh,
and
wow.
That sounds to me like it's going to be, their bottleneck right now is just battery. They don't have enough batteries. But if that's true, then that's really the death of the car industry.
Right.
I don't know. Just curious. Okay. Let me try to take. John, you okay for a few more minutes?
Yeah, sure.
Thank you. Question about COVID transforming global e-commerce. I guess maybe broader than that. I think we touched upon that, but maybe you could talk more if you like on that. There's a take the existing portfolio. Yeah, there's a question about what markets in particular in fintech that has caught your eye, or what themes in that. I think it's one of the five that you mentioned, financial services. Yeah, so interesting in that space. Mm-hmm.
Yeah, it is. That's a very interesting space. One of the challenges in the broadest sense of fintechs, whether it's banking, insurance, etc. The biggest advantage that the incumbents have is access to very cheap capital, that's sustainable capital. Mm-hmm. And that's been a very big competitive differentiation, and why it's been very difficult for fintechs to compete where capital becomes a differentiation. One area, for example, that it doesn't is on the payments side. And, one of the predictions that, not only we had, but I think a number of folks had was the banks were looking at competition in the wrong places. And they thought the competitors would be, other credit card companies or other financial institutions as defined. We actually thought it was going to be the social networks, and was really taking a page out of China and what they were doing, and how Alibaba is really the largest FI in the world. And I think the payments area where technology is absolutely critical, where it's difficult for an incumbent to play, is an area that I really like a lot. So I'd say the best execution has been Square Financial as an example, because where they're going to get to, and maybe they already have it done for all I know, is based on your every second, because they have complete knowledge of your entire cash flows every single second. They can actually tell you what the available credit that you can get on a every second basis. A bank could only do that by virtue of you doing a loan application. This takes it right out of the game. And the beautiful thing is they also cure their own risk management, that if they start to see the decreasing cash flows, they will already know, maybe this business is starting to run into trouble. Let me start to pull back some of the principal that we just loaned them. And so they could actually manage their own loan loss provisions. Again, unlike a bank where it goes through a whole series of channels. So that is one area that I really like a lot.
Me too. And the beauty of that space is you mentioned China. WePay and Alipay are so ahead of the West, right? Just because they leapfrog versus the US and Canada, it's much more fragmented because of established services. You could actually see the future by looking at what WeChat and WePay doing and Alipay, and there seems to be quite a few more things that can be done, right? Right. Exactly as you said. So that's interesting. So okay. There was a few more questions. I think there's a student that asked advice. John, what is your advice? Let me see, 1 second. Yeah, I think same. I think my daughters are also dialed in, the teenagers. What is your advice to young people, especially young ladies getting into the venture or tech space? Any general advice?
From an investment perspective, you mean, or
just maybe a young person thinking about getting into the space? Do you recommend it?
Yeah,
how should
absolutely.
They prepare for it?
I think it's going to be such a natural space that this is we're only at the front end of this. I mean, if what I would be doing is, you know this, San, as well as anybody. Um, not only is there a network of people, but there's also common, periodicals or blogs or newsletters, etc., that are followed by lots of folks. And so the information is easily retrievable, but it's highly networked group of folks. And what I would encourage, the younger you are, start to plug into that and start to really get a feel of the network, of the information. People love talking about, the latest cool tech, etc. And, there's lots of fun stuff and and there's a lot of acronyms as well too. And what happens, when you start reading up on this stuff, you start to realize, oh, you just meant this. Why do they use these fancy names? And I think it will give you a little bit of comfort and understanding. And really what you learn very, sort of quickly is, as an investor, particularly for private markets, really what you are is a pattern recognition expert. So the more you talk to, the more you read, and the more you see, the more enlightened you become, not because you're smarter, it's just because you have the ability to compare various things. And I would say that is really summarized, my career. I've been in this for a long time. It takes me a long time. But the one benefit that I have is I've just seen so many different deals, and you just get a little bit more focused and smarter on them. So I would encourage, as soon as you can, to start jumping in and starting to learn.
Great. John, I'll just ask one more question and we'll let you go. It's getting late. Who were your mentors, or who are your mentors? Who do you go to for advice to learn to be even better than you are? And perhaps that we could also tag along as well.
Yeah, I would say from a venture investing perspective,
just overall doing business investing, or venture. Yeah.
Yeah, I have the reason why I asked is I do have, depending on the issue, I have a number of them, depending on the subject matter expertise. But on the venture side, I would say the person who helped me out the most, and it was kind of funny, he didn't even realize how much he helped me until I told him when I saw him one time, was actually Fred Wilson at Union Square. He gave me some really helpful advice that I just didn't know, and it was nowhere to be found. And I do think he has, had the greatest track record career of a VC. And despite his first fund, it was pre-Union Square, that didn't do as well as he had hoped. But he's learned a lot, and the amount of insights that he shares with his followers, etc., is just, he's in a class by himself. So that is one individual who, to me, is a bit of a North Star for me. And I would wish, if I even have a fraction of his acumen, I'd be pretty happy.
Wonderful. And just for the audience, Fred runs Union Square Ventures out of New York. I think he does a daily email knowledge sharing. Does he still do that?
It's called AVC.
Yeah. ABC. Okay.
As in, I'm a VC, yeah.
Gotcha. Wow, that's great stuff, John. I'm going to have to listen to this a few times to unpack everything, but thank you so much. I think I've learned a lot. I'm sure the audience learned a lot. We're a little bit backlogged, but we will package this into something professional and share this with you prior to posting anything. Hopefully that's okay with you.
Yep.
And again, the lessons we'll dig through and try to insert this into making a much more colorful and impactful book when it comes out.
Great. Well, thank you so much for the opportunity.
Yes, thank you, John. I really appreciate it.
Okay, thanks.
All right, take care. Okay, bye-bye. Thank you, audience.
Thank you for joining us. Please visit Wizards Institute to access the blog summary of today's session, to learn more about other speakers, and to network with other investment wizards. Wizards Institute, the #1 community to learn smart investing and financial freedom.